This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, we described the problem of dealing with a company when it disposes of some but not all of its shares that it holds in another company. And that problem is, what cost figure do we now put against the sales proceeds? We know each individual figure of cost pertaining to each original figure of acquisition, but which shares are now going to be deemed to be sold? And what we discover is that we've got slightly different rules in terms of the matching rules that applied for individuals compared to the matching rules that now apply to companies. So, what are these rules that now apply? First of all, and consistent with what we did with individuals, when a company disposes of some shares that it holds in another company, we look firstly to see whether any of those shares that had been acquired on the same day. Those would be immediately and directly matched. Shares acquired on the same day as the disposal, we firstly match any such sale with those shares acquired on the same day. Whether that was in timing terms before or after the disposal, it doesn't matter. Shares acquired on the same day are the first shares now deemed to be sold. We then look at shares acquired in the previous 9 days. Now, I hope you do recall that when dealing with individuals, it was a rather stranger rule, that what we looked at was, after seeing whether any shares had indeed been acquired on the same day, we then looked for shares that in fact had not yet been acquired at all, but that we went on to acquire in the following 30 days. Not so in terms of companies, in terms of corporate tax. We go back, but we don't go back very far. Shares acquired in the previous 9 days. Now, if I were a betting man, which I'm not, I'd have said it's very unlikely in an exam question that you'd get shares acquired on the same day. Rather more likely that you'd see shares acquired in the previous 9 days, and of course that won't be all of the shares now sold. So where do we go after having looked back only over the previous 9 days? And that's where we use a term that we've used before with individuals. We now look at shares contained within the share pool, which of course will be made up of any shares acquired, now for companies, more than 9 days prior to this disposal date. And to begin with, as with individuals, the share pool records the number and cost of shares for each acquisition, and indeed disposal, just as it did for individuals. So again, we'll be running 2 columns, the number of shares, the cost of those shares. But that isn't all that goes onto that share pool. But, as we now say, we also have to deal with the fact that companies are entitled to indexation allowance. At least that is indexation allowance up to December 2017. Thus, whenever shares are purchased or sold, a reindexation of the index cost, this is going to be a 3rd column that now we have to include on our share pool, labelled index cost. A reindexation of the index cost of the shares in the pool is added to that index cost total, and this, as I've said, is recorded in a separate index cost column. So we're going to run 3 columns, number of shares, cost of shares, just like we did before, and now a new and 3rd column called index cost, which of course will contain each and every figure of cost incurred plus indexation. And that index cost column will have to be updated whenever we buy and or then sell any shares in the future, re-indexing as it's known through to that date of either disposal or indeed additional purchase of shares held. Once again, indexation factors will be given in the question, and indexation allowance is frozen at December 2017. Now, with that basic information in hand, we have example 2 here. Now, I'd like you to have a little read through example 2 to understand, therefore, what is going on here and try to make some sense of how, when we're told that A Limited sold 3,000 shares on the 10th of March 19, obviously what they tell us is the sales proceeds, but the sales proceeds is insufficient. We need to know the allowable cost of those shares. And we need to apply those rules of identification. Were there any shares that were also acquired on the 10th of March of 19? If not, were there any shares acquired within the previous 9 days? If there are any, then that particular disposal is matched with that acquisition first of all. Those are the first shares now deemed to be disposed of. And if there are then shares after that that were acquired more than 9 days ago, so not acquired within the previous 9 days, then they are to go into a share pool where we will record, but don't worry, we'll do that together, the number of the shares, the cost of the shares, and also then keep a running total going of indexation in the form of an index cost column. So what I want you to do to begin with is just to determine which 3,000 shares are now being sold, where will those shares come from, and in what order will we deal with them in. Okay, so let's see what we've got there for. Again, we've told that we're sold 3,000 shares on the 10th of March 19 for total proceeds of £36,000. Were there any shares acquired on the same day? No, there were not. Were there any shares acquired within the previous 9 days? Yes, there was. So there is the first and individual acquisition that we now determine this disposal to have firstly been a part of. So we sold 3,000 shares, therefore all of those 500 shares acquired on the 7th of March 19 are the first to be determined to have been sold. And we know what their cost is, £5,000. We sold 3,000 shares for £36,000. So our only problem now is determining how much of those proceeds of 36 relate to the 500 shares out of the 3,000 shares that were sold on that date. What is their proportion of those proceeds? So that therefore should be a simple enough exercise. So if we now therefore perform that exercise, we have got our sales proceeds to begin with. We are selling 500 shares out of 3,000 shares that we sold for a total proceeds figure of £36,000. If, of course, the question had told us the price per share, we could have just gone the 500 shares times that figure and that would be the proceeds. But we've got 500 over 3,000 times 36,000, and that, I believe, is proceeds of £6,000. Our identification rules have allowed us to determine that the cost figure is the cost that we incurred on that date of acquisition within the previous 9 days, and that was £5,000. We have therefore a gain of 1,000. Now, where you are recognising as you are here, shares acquired within the previous 9 days, or indeed if it was shares acquired on the same day, whether same day or previous 9 days, there is no indexation allowance. There's no indexation allowance. So whether that previous 9 days took you from the beginning of early in one month back to a previous one, the previous month, no, there is no indexation. So no indexation allowance there. So your £1,000 is in fact your chargeable gain. So we know that the first 500 of the 3,000 shares sold were those acquired within the previous 9 days, and upon which we have a chargeable gain of £1,000. So we've now accounted for 500 out of the 3,000 sold. So we now need to find where are the other 2,500 shares. So back to the question, and what we can see is that we had 2 earlier acquisitions, August 89, November 96. Where would those shares be included in terms of our rules of identification? They, of course, belong in the so-called share pool. And in that share pool, we're going to record three pieces of information. The number of shares either acquired or sold, the cost of those shares, and the so-called index cost of those shares. So what was the first acquisition that we had? So our first acquisition was the 20th of August, where are we, 89. It was an acquisition. How many shares then were acquired? 1,000 shares at a cost of £5,000, just copying straight out from the question as you see here. And whatever goes in the cost column also goes in the index cost column as well. So there you go, the £5,000 goes in there. So we're off and running so far as this share pool is concerned. There's our original acquisition. How many shares, what cost, also place that self-same cost into the so-called index cost column. Right. Now, having started it off, we move to the next relevant date. The next relevant date is the next acquisition, and that acquisition date is November 96. November 96. Right. Before you race ahead and start to write in that acquisition, no. The first thing that we do when either we come to a further purchase of shares, which we do here November 96, or the disposal of shares, or indeed December 2017, if that is before any of those particular transactional dates, what we always do is we re-index. We re-index the figure in this index cost column. We'll see the purpose of this in just a short while. This working here is merely determining for us in relation to the shares sold out of the share pool. We know those two acquisitions went into the share pool. Then what is their cost and what is the indexation allowance that relates to them? That's the purpose of this working. We'll then take those figures from this working and separately show the calculation of the gain. But to be able to compute the gain, we need to know cost and we need to know indexation allowance. That is what the share pool does for us. So, original acquisition in. Next relevant date, November 96. We re-index, therefore, to that date. So we now re-index to, and that is, let me just abbreviate that, sorry there, I've got much room, to November 96. The index cost figure is 5,000. We now simply refer to the list of indexation factors provided to us, and we know that we need an indexation factor that runs from August 89, when those shares were firstly acquired at a cost of £5,000, through to November 96. Well, there we go. August 89 to November 96. That is 0.329. 0.329. Now, get your calculators out and work out what that figure is. And that figure goes to only one column. The index cost column is where it goes. In the index cost column, we will record any cost figures that are incurred, plus our re-indexation of the index cost column through to either a date when more shares are purchased, or through to December 2017, or eventually through to the date of disposal. So 5,000 times 0.329, now please check, but I made that to be £1,645. So at that point I've got £6,645 worth of index cost. I now add in the addition, and the addition on the 16th of November 96 was 2,000 shares at a cost of £12,000. So 2,000 shares, any cost figures into the cost column, of course, and into the index cost column, just as we did with the original acquisition. So at November 96, we had in total 3,000 shares held within the share pool that had a cost figure of £17,000 and at that date had an index cost of £18,645. Okay, what's the next relevant date for us then to re-index through to? Well, the disposal, we're told, occurred on the 10th of March 19. Remember that March 19, 7th of March 19 disposal has already been dealt with. Those were the first shares deemed to have been disposed of on the 10th of March, the ones bought on the 7th of March, i.e. within the previous 9 days. So we now will re-index through to the last date that any indexation can be required to be performed to, and that's to December of 17. We re-index to December 17. So we're looking for an indexation factor running from November 96 to December 17. November 96 to December 17, 0.82. What figure do we re-index? The index cost figure. What is the index cost? £18,645 times 0.82, 820, so 0.82. Again, time to get your calculators out and work out that figure. Again, please do check mine, but I made that figure 15,289. We therefore add that in so that as at the date of disposal on the 10th of March 19, held within the pool would be some 3,000 shares with a cost of £17,000 and with an index cost now that adds up, I think, to £33,934. £33,934. Well, the next relevant date, but a date to which there is no re-indexation to perform, that stopped at December 17, but is now the disposal date. The disposal was, well, that was the 10th of March there of 2019. The disposal. How many shares are we now selling from this pool? Well, the total sale was 3,000 shares, 500 of which have already been accounted for. That was the acquisition within the previous 9 days. So we are now dealing with 2,500 shares coming out of this share pool. Now, just like we did when dealing with individuals, it's a share pool. So it comes out on an average basis. So we are selling 2,500 out of 3,000 shares. So we will take that fraction, 2,500 over 3,000, times each of the cost figure and then the index cost figure and record them accordingly. So if you could do that calculation for me, please, to establish those 2,500 shares would have carried with them what allowable cost and what amount of index cost. So pause at this point for you to do that, and when you come back, we'll look at what the answer looks like and see whether it agrees with what you've got. Okay, well, a quick look through the answer together now. We'll see that in relation to dealing with the share identification rules, we firstly realised that there was no acquisition on the same day as the disposal. There was an acquisition within the previous 9 days, that being of 500 shares. We know what the cost of those shares was, 5,000. We've simply got to work out what proportion of the total proceeds of 36 belong to those 500 shares sold, and as we computed before, that was £6,000. Therefore, the chargeable gain 1,000. And that accounted for 500 shares out of the 3,000 shares sold. So we've got to go and find now the remaining 2,500 shares that are being sold from within the share pool. So as we've seen, we have our 3 columns, number cost and index cost, kicked off by the original acquisition. re-indexing through to November 96, the date of what was then the subsequent and only other addition made into the share pool, that being in November 96, as we said. But again, remember, re-index, then put the addition in, reform your totals and move on to the next addition, or December 17, or disposal date, whichever of those comes first. So we add in the addition for November 96. There's the numbers there for the 2,000 shares. Revises the index cost at that date to 18,645. Nothing else happens before December 17. That's the latest date that indexation can run to. Pick up the indexation factor, apply to that index cost total, put the figure in. That means that at the point of disposal, 3,000 shares, cost 17, index cost, well again, numbers permitting here, hopefully I've got my calculator sorted, 33,934. We are now selling 2,500 of those 3,000 shares. So as it is a pool, we take for those 2,500 out of the 3,000 that fraction of cost and index cost, and those numbers, it would appear, would be 14,167 and 28,278 respectively there. Now again, we're not interested in as much as we only got to compute the gain on this disposal with what remains within that share pool for purposes of, well, should and whenever those remaining 500 shares be sold. But this was the critical information that we've established here. Now remember, this share pool is a working. It's there not to give you the chargeable gain on the shares sold, but to give you the information to compute that gain, i.e. what cost and indexation allowance will be available to you. So let's do the gain calculation on those 2,500 shares. There's the remaining part of the proceeds, £30,000. The cost we already know, 14,167, in it comes. The indexation allowance, well, that is the difference between the index cost column and the cost figure. That was 28,278 in terms of the index cost that pertained to the 2,500 shares sold, as compared to 14,167 worth of cost. That's 14,111, I hope, and that brings you down to a chargeable gain of 1722. Now, of course, what you might have been able to more quickly and easily do is simply deduct the 28,278 there from your sales proceeds. The reason why I've shown it this way, the proper way, is that you must remember that indexation allowance cannot serve to increase or create a loss. So we needed to know, therefore, if that index cost, there it was 28,278, that was less than the proceeds of 30, but had it been more than 30, you'd have to differentiate between what was cost and what was indexation, because indexation cannot serve to increase or create a loss. As soon as you see that it's a chargeable gain, then remember that this is an objective testing question. All that matters is, do you get the right answer? All the lovely workings that we've shown here and the precision of them and the detail within them, they don't get to see. That's what you are doing, so if you can shortcut this, abbreviate it, then you do so. If, of course, you're doing it in answer to a Section C question, your constructed response, your written answers there, then you show it as we have identified here. But the chances are this is going to be something you're either doing in Section A or potentially Section B. Small chance in terms of Section C that maybe in the corporate tax question, the guaranteed 15-mark question there, you may have a chargeable disposal to deal with. And if that chargeable disposal is of shares, this is what you do. This is how you present that written answer. If it's an OT question, objective testing question, sales proceeds 30, index cost 28,278, take one from the other, and there's your gain of 1722. Remember, of course, that that is only the gain on the 2,500 shares. We also had the gain on the shares that were acquired in the previous 9 days. That was 1,000, add the 1722. There you go. We've got 2722 as the total gains arising in relation to this particular disposal of 3,000 shares. Okay, back to our notes therefore, once you've thoroughly revised and reviewed through the exercise done there. But it is purely a mechanical exercise. Do the things in the right way, you get the right answer. Well, calculator permitting, of course, there. But there's very little theory as such, it's all principles, it's just those are the rules. That is what you must do. That is how you follow those rules. But going back to our notes, a couple of other issues just to quickly deal with in terms of this lecture. We have seen that the way that we have acquired shares in the previous example was the obvious way. You've gone out and bought, the company has gone out and bought shares in some other company. But as I hope you recall from when we looked at this in personal taxation for individuals, when we looked at capital gains tax, then we could acquire shares directly from the company itself rather than going and buying the shares from some existing shareholder. And that is if the company makes a bonus issue and or a rights issue, and we, in the case of rights, take up our rights to that rights issue, then shares can be acquired in either of those two ways. How do we deal with those? Because these will relate back to the original shareholdings, so this is something that will have to be dealt with within your share pool calculation. Firstly, bonus issues. Remember what happens. A bonus issue means you get more shares, so it increases the number of shares held, but they're free shares, so there's no corresponding increase in cost. So in terms of your share pool, the only thing that's going to change is the number of shares. So the bonus shares are simply added to the number of shares column within the pool. There's no change in cost and therefore no change in index cost. And because of that, therefore, we do not re-index or index the cost of the original shares through to the date of the bonus issue, as no new cost is incurred. When you buy shares pre-December 17, or as we'll see in a moment, if there is a rights issue of shares, which means again you buy shares, there is a cost incurred. Wherever there is a cost incurred, then to the date of that transaction, whether it's a purchase as an outright purchase from an existing shareholder, or whether it's from the company through the means of a rights issue, you always re-index your index cost to that date. The only time that won't happen, of course, if any of these transactions, the purchases or rights issue, occurs after December 17, where there is no indexation to do. We only re-index, of course, up to December 17. Okay. A rights issue, again, increases the number of shares held, but this time, of course, there is a cost. You are acquiring the right to buy shares in the company, but of course at a preferential price there. So there will be a cost that is associated with the shares. It is therefore dealt with in the same way as any other acquisition. So just like in the previous question done, where you bought shares from an existing shareholder, you still establish how many shares are being acquired. You have to do that, of course, this time, carrying through the terms of the rights issue. 1 share for every 3 shares held, 4 shares held, 2 shares for every 5 shares held, whatever it might be. You establish the number of shares, you be told what the company has to pay under the rights issue for each such share, and you therefore work out that cost. And that cost goes into both the cost and the index cost column. It also, of course, needs to be indexed through to the date of the rights issue, assuming that is before December 17. We do not index past December 17. So if the rights issue is occurring after December 17, there'll be no re-indexation, no additional indexation to add in. So the index cost in the pool is indexed to the date of the rights issue. The right shares are added to the number of shares column, and the cost is added to both the cost and the index cost columns within the pool. The only problem you face is computing how many shares are required under the rights issue, i.e. follow the terms of that rights issue. So let's see what we've got here in terms of example 3. We've got to calculate the gain on the disposal of the shares in March 2019. We're told here that Y Limited sold 2,000 shares in March 2019, and there's the proceeds, 12,000 for the 2,000 shares sold. How did we acquire those shares? Well, originally Y Limited acquired what were 3,000 shares in another company, X Limited, July 93. There's the cost, £10,000. In February 95, X Limited made a 1-for-3 bonus issue. And that's it. So in which case, therefore, there are no acquisitions on the same day, no acquisitions in the previous 9 days. So all we have to do is to construct our share pool. Number, cost, and of course indexed cost there. And what's going to go into that share pool? There was one original acquisition that we had, and that was, where are we, back in July 93 there. So July 93, 3,000 shares at a cost of 10,000, and we put the same cost into the index cost column. Next relevant event here was February 95. February 95 was a 1-for-3 bonus issue. Now then, because it's a bonus issue, there are no additional costs incurred here. So all we simply do is to put through the effect of that bonus issue. And the bonus issue, obviously you'd have more room on your page in front of you. What was it? 1-for-3. Bonus issue, 1 share for every 3 shares held. Well, that's simple. On 3,000, we get another 1,000 shares. Nothing happens to the cost. 4,000 shares, still with a cost of 10,000. And we haven't touched the index cost. That's still £10,000. So no re-indexation of the pool there. Though be aware that what will happen in an exam question, almost certainly, which is what I've done in terms of these indexation factors here, the examiners have a tendency to give you, the candidate, enough rope by which to hang yourselves, because they will give you an indexation factor to the date of the bonus issue. July 93, February 95. July 93, February 95. Don't be tempted to use it just because it's there. That is irrelevant here. There is no re-indexation that will occur. What we know is that the re-indexation that will occur is the re-indexation that takes place from when was the original cost incurred, July 93. The disposal is not until March 2019. So what we're going to have to do is to re-index, as we did in the previous problem, through to December 17 from July 93. Do we have an indexation factor? Yes, we do. July 93 to December 17. Again, we've ignored the February 95 date, the bonus issue date there. July 93 to December 17, 0.991. Now we're applying that, of course, to our figure of index cost of 10,000. So 0.991, obviously put it through your calculator, but you're going to find that that is going to be £9,910, upping that to 19,910. That was the state of the pool at December 17. It is equally the state of the pool at March 19 when we have a sale. And the disposal, get the pen to work, was of how many of these shares? We sold 2,000 of those shares, half the shares. So we will take with that half of the shares, half of the cost, 5,000, and half of the index cost. You can work that through and then proceed to do your gains calculation. You will therefore know that the gains calculation will read sale proceeds £12,000, less if we go to the trouble of doing it we know that the cost is £5,000, and the indexation allowance will be the difference between whatever that figure says and that figure of cost. Of course, what we could do quite simply is just pick up whatever is the figure of index cost, 9955, and deduct that straight from the 12,000, as clearly we are not getting into a loss situation. So you could go directly to it, and you would do if you were dealing with an objective testing question. If it's a written question in section C, do it the proper way. Show the markers that you know the correct techniques to apply. Don't shortcut in terms of section C workings. You identify them. We will only shortcut when it's objective testing, because the only thing that will get you marks is the only thing that will get you marks is you've chosen the correct letter based on your particular determination of which particular answer is the correct one. So you can abbreviate to your heart's content in terms of the workings that you do, but just make sure that you understand the workings that you do. That therefore will allow you to compute your gain here. Now again, review through, make sure you're happy with that. The only thing that I would mention is if, of course, back in February 95, that instead of it being a bonus issue, it had been a rights issue, then you would indeed have indexed the original index cost of 10,000, the original cost of 10,000 incurred in July 93, through to February 95. Then you'd have added in the number of shares acquired. Well, here it was 1,000 shares at whatever cost was incurred, and that would go in both your cost and your index cost columns. You treat it like any other purchase. Okay, have a look through the answer, please, to that question in the back there. And in our next and hopefully very short final session together in this chapter, we will deal with the more interesting scenario of takeovers. But that awaits us next time.